Okay, so you've probably been online, maybe seen some videos, heard the chatter.
Oh, yeah. About foreign countries supposedly dumping US Treasuries.
Exactly. Because of the new tariffs that kicked in early this year, 2025, and this whole fear about, de-dollarization speeding up.
It's definitely getting traction.
Right. So what we want to do in this deep dive is really look at that claim. We'll dig into the economic data, official holding stats, expert takes, everything up to about mid-April 2025.
And see if that narrative actually holds water.
Yeah.
Because, well, it might not be quite so straightforward.
Yeah. Expect some nuances, maybe.
Definitely. Sure. Let's start with the backdrop. Early April 2025. What's quite interesting is inflation. The CPI numbers for March came in surprisingly moderate.
Moderate how?
Well, 2.4% year over year, and actually down 0.1% month over month. That was below what forecasts were suggesting.
Okay, hang on. Because at the same time, Treasury yields were going kind of nuts, right? Especially the 10-year.
That's the puzzle. Yeah, the 10-year yield spiked pretty sharply. It hit 4.40% by April 10th, and I think it even touched 4.51% intraday.
Which is weird because usually lower inflation might suggest lower yields, or at least stable ones. So something else must have been pushing them up.
Precisely. Other factors were clearly in the mix. You also had the whole money supply situation, M2, which had been, frankly, all over the place.
Surge, contraction, then sort of recovering.
Exactly. And then you throw tariffs into that. It just creates more conflicting signals for where the economy's headed.
And the yield curve, that spread between the 10-year and 3-month yields.
Still very flat. Near zero, maybe slightly negative. Usually that screams recession warning.
But the way yields were moving, long-term yields rising while stocks were falling, that felt a bit atypical for that signal, didn't it?
It did. Very unusual behavior. And then there's the dollar.
Ah, yes, the dollar. Safe haven, right? Market jitters usually mean dollar strength.
But not this time, interestingly. Early April, the DXY, the dollar index, actually fell. Slipped below 102, getting close to multi-year lows.
Which feels significant, maybe because the shock, the tariffs, originated in the U.S. this time.
That's a plausible explanation.
Yeah.
It kind of eroded that simple safe haven narrative, perhaps. And looking bigger picture, we know the dollar's share of global reserves has been slowly declining.
Right, that's a long-term trend. It was down to about 57.8% at the end of 2024.
Yeah, but critically, it still dominates trade invoicing, international finance. It's still number one by a long shot.
Okay, let's pivot to that Treasury auction, the one on April 9th, because some of the online talk was about it being a failed auction.
Right, that narrative was out there. But the actual data tells a very different story.
How so?
Well, look at the demand metrics for that 10-year note auction. The bid-to-cover ratio was 2.67. That's strong. Highest since December, actually.
Okay, so lots of bids for the amount offered.
Exactly. And there was a stop-through, which means bids were accepted at a yield lower than where it was trading right before the auction deadline. That signals aggressive bidding.
And the foreign component?
This is key. Indirect bidders, which is the category that includes foreign central banks and other foreign buyers, rewarded a record 87.9% of the auction.
Wow, okay. So far from failed, that sounds like really strong foreign interest.
It certainly points that way, which kind of complicates the simple foreigners are fleeing story.
So let's tackle that sell-off argument head on. The logic feels intuitive. Tariffs make the U.S. less reliable. Countries lose trust. They sell treasuries, move away from the dollar.
The logic isn't crazy in the surface, but de-dollarization, as we said, is a very slow, long-term thing with roots far deeper than just these recent tariffs.
And the market reaction we saw, stocks down, yields up, dollar down, it could fit that narrative of declining foreign confidence.
It could partly reflect that, yes, but it's much more likely a blend of things interacting. Maybe some selling by foreign official accounts, sure, but also maybe rising inflation expectations because of the tariffs themselves.
Right, tariffs can push up prices.
Plus potential market liquidity issues and maybe, just maybe, a bit of a dent in the dollar's appeal of the ultimate safe asset right now.
And doesn't this also feed into bigger worries about U.S. debt, the fiscal picture?
Absolutely. If tariffs are seen as potentially harming growth or worsening deficits, that adds to existing concerns about U.S. fiscal sustainability, which could also make some foreign investors nervous, separate from just the trust issue.
So what did the actual latest data on foreign holdings show around that time, like from January 2025?
Okay, so the January data show total foreign holdings were still really high, $8.427 trillion.
Yeah.
But their share of the total U.S. debt outstanding has been trending down over the longer term.
But were they net sellers in January?
It's mixed. Foreign official institutions think central banks were actually net sellers of long-term treasuries in January, but foreign private investors were net buyers.
Ah, okay. So private demand offset official selling in long-term debt.
In that month. For long-term, yes. And if you look at short-term T-bills, there were net purchases overall by foreigners. The crucial point is we didn't have Feb or March data yet in early April to see if the tariffs caused a big acceleration of selling.
Got it. So based on everything available in mid-April 2025, the verdict on this claim of a massive tariff-driven foreign sell-off.
It seems definitely overstated, premature, at the very least. Yes, there's a trend of official selling over time, but the idea of a sudden panicked rush driven purely by the early 2025 tariffs wasn't really supported by the data we had.
Especially not with that strong April 9th auction result.
Exactly. The market wobbles likely had multiple drivers, not just a foreign stampede for the exits.
So it really goes to show you can't just take these simple online narratives at face value when it comes to complex global finance.
Absolutely not. It forces you to ask deeper questions like, okay, even if private foreign demand is holding up for now, what does it mean long-term if foreign central banks are gradually easing back on holding long-term U.S. debt?
That's a big question.
And how might, continued unpredictability in U.S. economic policy, like more surprise tariffs, perhaps affect those trends down the road?
Definitely food for thought. It's a reminder that the global financial system and the dollar's place in it is always evolving. Well, thanks for breaking that all down with us.
If you like this kind of content, please hit the like and subscribe down below. If you don't like it, let me know why. Take care.